CBDCs explained simply central bank digital currencies, CBDCs. The future of money or the end of financial freedom. We live in an era where money is no longer what it used to be for thousands of years. Once, money was stones, shells, and metals. Then it became paper banknotes. Later, it turned into electronic records in banking systems. And today we are standing on the threshold of the next stage, the emergence of central bank digital currencies, or CBDCs. These are not cryptocurrencies like Bitcoin. They are not bank transfers through apps. They are not even electronic money in the traditional sense. CBDCs are money issued by a country's central bank, existing entirely in digital form. And most importantly, they could fundamentally change how the economy, banking systems, and even government control over citizens' finances work. In this video, we will explore what CBDCs are in simple terms, why governments need them, how they differ from cryptocurrencies, which countries are already testing them, their advantages and risks, and most importantly, where all of this is heading. What are CBDCs? In simple terms, CBDC stands for Central Bank Digital Currency. Simply put, it is a digital version of cash issued by the central bank. If you have $100 in your bank account today, that is not a CBDC. That is a liability of a commercial bank. If CBDCs are introduced, you could have $100 in digital form directly issued by the European Central Bank. This means the middleman, commercial banks, could be bypassed. Why did CBDCs appear in the first place? At first glance, one might ask, why change anything? We already have cards, online banking, Apple Pay, and Google Pay. But central banks have several reasons. 1. Declining use of cash. In many countries, cash is disappearing. People pay with cards and phones. Cash is harder to track. Maintaining banknotes is expensive. CBDCs are a way to digitize cash. 2.2. Competition. With cryptocurrencies, the rise of Bitcoin and other cryptocurrencies showed people are willing to use alternative money. Financial systems can exist without banks. CBDCs can be seen as a state response. If digital money is inevitable, better we issue it ourselves. 2.3. Stronger monetary policy tools. CBDCs give central banks new capabilities. Direct payments to citizens, instant economic stimulus, precise control over money supply. For example, governments could issue money with expiration dates, encourage spending in specific sectors, react instantly to economic crises. 3. Fighting corruption and the shadow economy. Every CBDC transaction could be traceable, transparent, recorded by the central bank. This reduces money laundering, tax evasion, illegal transactions, but it also raises privacy concerns. CBDCs versus cryptocurrencies. It is important not to confuse CBDCs with Bitcoin. 3.1. Centralization. Bitcoin. Decentralized CBDCs. Fully centralized CBDCs are controlled by the state. 2. Issuance. Bitcoin. Limited supply CBDCs, issued by central banks as needed. 3. Anonymity. Bitcoin. Pseudo-anonymous CBDCs, potentially fully transparent. 3. Purpose. Cryptocurrencies. Independence from governments. CBDCs, strengthening state monetary control. Types of CBDCs. There are two main types. 1. Retail CBDCs for everyday people. Payments, transfers, salaries. Example, digital euro or digital ruble. 4.2. Wholesale CBDCs used between financial institutions. Interbank settlements. Large transactions, cross-border payments. 5. Countries already testing CBDCs. CBDCs are not theoretical. They already exist in pilot form. 1. China. Digital yuan. China is a global leader. The project is called ECNY. It is being tested in major cities' transportation systems, online commerce. Key features: integration with mobile apps, offline payment capability, strong state oversight. 2. European Union. Digital euro. The European Central Bank is actively researching it. Goals include maintaining control over currency, competing with private payment systems, simplifying cross-border payments. 3. United States, digital dollar, under discussion. The Federal Reserve is studying the concept, but political debate privacy concerns banking system influence are slowing progress. 5.4. Russia. Digital ruble already in testing phase. Features. Usage through participating banks gradual rollout central bank control. Price. Bahamas. Sand dollar one of the first fully launched CBDCs used to improve financial inclusion, simplify payments across islands. 6. How CBDCs work technically. In simple terms, CBDCs operate through a central bank digital platform. 1. Digital wallets. Each user has a wallet. Mobile app banking app government system. 6. 2. Direct central bank accounts. Money is stored directly with the central bank, not commercial banks. 6.3. Direct transactions. Payments occur between sender-receiver central bank system. No intermediaries. 6.4. Programmable money. One of the most controversial features, CBDCs can be programmed, expiration dates, spending restrictions, usage conditions. For example, food aid can only be spent on groceries. Stimulus money expires in 30 days. Advantages of CBDCs. 7.1. Fast and cheap payments, instant transfers. No bank fees, no intermediaries. 7.2. Financial inclusion. People without bank accounts can store money, make payments, receive government support. 7.3. Better monetary policy. Governments can distribute aid instantly, stabilize economies, respond to crises quickly. 4. Crime reduction. Transparency helps reduce illegal transactions, tax evasion, money laundering. Risks and downsides of CBDCs. 8.1. Loss of financial privacy. Every transaction could be monitored, tracked, analyzed. 8.2. Control over spending. Theoretically, governments could block payments, restrict purchases, set spending rules. The impact on banks. Commercial banks may lose deposits, lending capacity, influence in the system. 8.4. Cybersecurity risks. CBDCs introduce hacking risks, system failures, digital infrastructure attacks. 5. Centralization of power. CBDCs significantly increase state control over financial life. This raises concerns about surveillance, economic restrictions, digital dependence. What supporters and critics say. Supporters argue CBDCs are the future of money. They improve efficiency. They reduce crime. They modernize economies. Critics argue they reduce privacy. They increase state control. They may lead to financial surveillance. 10. The future of CBDCs is CBDCs will not replace cash overnight. Instead, we will see a gradual transition. Cash plus digital currencies plus banking systems, parallel financial ecosystems, phased adoption across countries. Possible future scenarios. CBDCs become the global standard. CBDCs coexist with cryptocurrencies, hybrid financial systems. Emerge. Conclusion. Central bank digital currencies are not just a technological upgrade. They represent a fundamental transformation of money itself. Where money used to be physical, partially anonymous, bank-mediated, CBDCs make it fully digital, centrally controlled, directly linked to the state. And the key question remains, will this lead to a more efficient financial system or a more controlled one? The answer will shape the economy of the 21st century.